The investor who looked beneath the AAA ratings of subprime mortgage bonds while the entire financial world was busy levering up on them has just executed the most dramatic exit of his career. On 10 November 2025, Michael Burry's Scion Asset Management formally deregistered with the Securities and Exchange Commission, converting itself into a private family office that no longer owes the public a single 13F, a single performance figure, or a single explanation. This is not the quiet closure of a manager who underperformed. This is the second time in 17 years that the same man who earned his investors 489% in 2007 and himself well over $100 million has looked at the global pricing mechanism for risk assets and concluded that the relationship between reality and quotation has snapped beyond repair. In the summer of 2007, he returned outside capital while the S&P 500 still stood within 4% of its all-time high, while CNBC anchors were still mocking him as Big Short Doomsday Guy, and while the Federal Reserve was still insisting that subprime difficulties were likely to be contained. 6 months later, the containment failed so spectacularly that the entire monetary system required direct government life support. The fact that he has now repeated the gesture under almost identical psychological conditions should send a wave of ice water down the spine of anyone still fully invested in public equities. If you're interested in personal finance, hit subscribe and give this video a like right now. And now, let's move on. The letter he sent his few remaining partners on the 27th October 2025 was characteristically terse yet devastating in its implications. He wrote that his internal valuation work is not now and has not been for some time in sync with the markets, adding that the divergence had become structural rather than cyclical and showed no realistic prospect of reversal under prevailing monetary conditions. When the same brain that once calculated, pool by pool, the exact month when hundreds of thousands of California option ARM mortgages would flip from negative amortization into full payment shock, now declares that valuation itself has become an obsolete exercise. The statement carries the weight of a coroner's report rather than an opinion piece. His final public 13F filing, covering holdings as of 30th September 2025, revealed bearish option positions of a size that dwarfed even his famous subprime trade, $912 million, notional input options on Palantir technologies with expiration dates scattered across 2026 and deep into 2027, plus another $186 million in long-dated puts on Nvidia Corporation that do not mature until the second half of the decade. These are multi-year structural convictions, not tactical hedges against a garden-variety correction. They are declarations that the entire artificial intelligence complex has achieved the same degree of mathematical detachment from cash flow reality that the housing market displayed at its absolute manic peak. Burry has been unusually explicit, at least in private communications that subsequently leaked, about the precise accounting distortion he believes is manufacturing the current profitability illusion. He has charged that the largest hyperscale data center operators have quietly extended depreciation schedules for specialized AI training hardware from the realistic economic life of 36 to 60 months to 10, 12, and in some cases 15 years, thereby shifting tens of billions of dollars of capital expenditures out of current period expense and into distant future quarters. The effect is immediate and dramatic. Earnings per share receive an artificial boost that directly increases the value of executive stock option grants, supports analyst price targets measured in hundreds of times trailing earnings, and creates the appearance of a profitable industry when the underlying cash economics remain deeply negative after normalizing for realistic equipment obsolescence. One leaked message reportedly contained the sentence, "They are doing to CapEx what the originators did to LTV ratios in 2006. Stretching the assumptions until the model says whatever they need it to say. If regulators or the FASB were to enforce standard 3 to 5 year depreciation lives across the sector tomorrow morning, the earnings restatements would be measured in tens of billions of dollars per quarter for each of the Magnificent Seven, and the valuation justification for multiples exceeding 300 times earnings would evaporate overnight. The decision to go permanently dark at the exact moment when the S&P 500, the NASDAQ 100, and virtually every global risk asset trade within a few percentage points of all-time highs represents something far more sinister than ordinary portfolio reallocation. After November 2025, the investing public will be blind to Michael Burry's thinking forever. The single most proven diagnostician of fatal market mispricings has chosen to disappear from mandatory disclosure at the precise moment when his vision would be most valuable to those trying to anticipate what comes next. His final public post on the platform, still known to many as Twitter, dated 25 November 2025, consisted of 6 words: "On to much better things." The phrasing is deliberately ambiguous, yet anyone familiar with his 2008-2009 correspondence recognizes the quiet satisfaction of a man who has once again positioned his family on the right side of history, while the rest of the world remains oblivious to the storm forming on the horizon. This marks only the second occasion in Burry's career when he has voluntarily returned outside capital while broad equity indices were still ascending. The first instance occurred in the second half of 2007, when he shut Scion to new investors and began mailing redemption checks, even as the financial media continued to portray him as a delusional contrarian who had missed the greatest housing boom in American history. The fact that he has now replicated the gesture under virtually identical market psychology and with even larger bearish positioning should be treated as the clearest distress flare any observer could hope to receive. The historical track record of such voluntary withdrawals by legendary value investors during periods of extreme optimism is so consistent that it constitutes one of the most reliable leading indicators in the entire recorded history of financial markets. In the spring and summer of 1929, Jesse Livermore, the greatest speculator of the early 20th century, methodically liquidated every long position in his personal and proprietary accounts, while margin debt reached levels that represented nearly 13% of GDP, and investment trusts were issuing new securities backed primarily by shares in other investment trusts, creating infinite loops of paper prosperity, while the financial press proclaimed the arrival of a permanent high plateau, and brokerage houses ran full-page advertisements predicting the Dow Jones Industrial Average at 500 or higher. Livermore told close associates that he could no longer locate a single common stock trading below any reasonable estimate of liquidation value. His conclusion was simple and brutal. When price completely divorces itself from underlying cash generation, the only rational course is to step aside or bet actively against continuation of the delusion. The crash that began on Black Thursday, 24 October 1929, and continued until the summer of 1932, vindicated his analysis with merciless precision. The industrial average surrendered 89% of its peak value, and Livermore's timely short positioning generated profits equivalent to approximately $1.5 billion in current purchasing power. 71 years later, in the first quarter of 2000, Julian Robertson executed what the financial media instantly branded as the professional suicide of a once great manager. Tiger Management had compounded capital at more than 31% annually for 2 decades straight, growing from a few $100 million under management to a peak above $22 billion. Yet Robertson sent a letter to investors announcing immediate and complete liquidation because the valuation discrepancies between the technology, internet, and telecommunication stocks driving the mania and any conceivable cash flow justification had become so extreme that continuing to manage outside capital would violate every principle he had ever followed. The letter contained the unforgettable sentence: "The current infatuation with technology and internet stocks bears no resemblance to rational investing." Television pundits ridiculed him as a dinosaur who had failed to grasp the transformative power of the new economy. Chief executives of companies with no revenue and no realistic path to profitability appeared on magazine covers proclaiming the death of the business cycle. Exactly 31 days after Robertson mailed the final redemption checks, the Nasdaq Composite recorded its all-time closing high of 5,048.62 and began a 78% decline that erased $5 trillion of market capitalization and revealed the hollow core at the center of the entire dot-com phenomenon. The choreography repeated itself with almost eerie fidelity in 2006-2008. While the National Association of Realtors spent millions on national advertising campaigns insisting that There has never been a better time to buy or sell a home, and while lenders were issuing mortgages with loan-to-value ratios of 100% or higher on stated income alone, Michael Burry was sitting in a small office in San Jose reading the actual loan-level tapes that Wall Street had packaged into collateralized debt obligations. He discovered layer upon layer of silent second liens, piggyback 80-20 combos, and negative amortization options that guaranteed mass default the moment teaser rates reset. When he began purchasing credit default swaps that would pay out precisely under those conditions, his own investors revolted. One large institution sued to withdraw capital, and the financial press portrayed him as a paranoid eccentric who had lost his edge. 6 months after he returned their money and converted Scion into a family office, Lehman Brothers filed for bankruptcy, AIG required a government rescue measured in hundreds of billions, and the entire global financial system teetered on the edge of collapse. The phenomenon is not limited to these 3 iconic cases. David Einhorn spent much of 2020 and 2021 documenting how Federal Reserve emergency policies had severed the link between risk and return, while Seth Klarman of the Baupost Group, author of the most sought-after book on value investing ever printed, actually returned significant client capital in 2020, with a letter explaining that the combination of zero interest rates, unlimited quantitative easing, and the suspension of mark-to-market accounting in certain sectors had created the most dangerous environment he had encountered in 40 years of professional investing. Markets subsequently rallied another 50% after both warnings, yet the underlying distortions they identified never resolved. They simply metastasized. The unifying mechanism is as simple as it is terrifying. When central banks suppress the cost of money to zero or below for more than a decade and expand their balance sheets by tens of trillions of dollars, the traditional governor on speculative excess disappears. Any narrative that can be framed as participation in the next secular growth wave attracts essentially unlimited capital regardless of current cash flows or absence thereof. The smartest and most disciplined investors eventually reach the point where continuing to participate requires them to abandon the very analytical framework that made them successful. Their withdrawal removes the last cohort of natural buyers who would otherwise provide support during periods of extreme pessimism, leaving the market vulnerable to a vacuum collapse the moment sentiment shifts. Michael Burry's 2025 positioning indicates that he has identified the artificial intelligence complex as the latest and quite possibly the largest manifestation of this ancient cycle. Palantir trades at a price-to-earnings multiple that would require roughly 3 centuries of current profits to justify today's market price, even if earnings remain constant forever, an assumption no serious analyst would defend. Nvidia briefly achieved a market capitalization larger than every publicly listed company in China combined. The 7 technology giants now command a combined valuation greater than the annual economic output of the European Union. These are not the vital signs of sober investment. They are the hallmarks of speculative mania in its terminal phase. The broader monetary backdrop replicates with disturbing precision the conditions that nurtured every previous bubble. Real policy rates have been negative for most of the past 15 years. Household and corporate balance sheets are levered to levels that eclipse even 2007 peaks when measured against GDP, and the Federal Reserve's balance sheet still stands at nearly $9 trillion, despite tentative attempts at normalization. Under such conditions, the phrase, "this time is different," always achieves religious status immediately before the exact opposite proves true. In 1999, it was the internet changing everything. In 2006, it was real estate never going down. In 2025, it is artificial intelligence representing the 4th industrial revolution, but the underlying dynamic is identical. Unlimited cheap money chases the latest story until valuation ceases to exist as a concept, and the only question becomes who will be left holding the bag when the music stops. History has demonstrated with ruthless consistency what happens when investors of Burry's caliber conclude that rational analysis has become incompatible with survival in public markets. They do not fight the tape indefinitely. They either position themselves to profit from the coming correction, or they simply remove themselves from the game entirely. The tragedy is that the ultimate victims are almost never the sophisticated institutions that ride the bubble to its apex, But the millions of ordinary households whose retirement accounts, pension funds, and college savings plans are now overwhelmingly concentrated in passive index vehicles that own the market at any price. When the reckoning finally arrives, liquidity will evaporate with terrifying speed, and the decline will feed upon itself until the gap between price and reality has been closed at any cost. Michael Burry is not offering a forecast that can be dismissed as the habitual pessimism of a scarred 2008 veteran. He is repeating, with updated targets but identical methodology, the diagnosis that allowed him to generate returns measured in hundreds of percent while the financial system melted down around him. The man who saw fraudulent lending practices dressed up as financial innovation, the last time now sees fraudulent accounting practices dressed up as technological revolution this time. In 1929, Jesse Livermore saw through the investment trust pyramid scheme. In 2000, Julian Robertson saw through the dot-com revenueless miracles. In 2008, Michael Burry saw through the subprime tranching charade. And in 2025, the same Michael Burry sees through the AI depreciation shell game that currently supports valuations more extreme than any previously recorded. Each time the crowd laughed, each time the crowd lost everything, and each time the person who walked away early preserved and multiplied capital, while the rest discovered that gravity still applies to financial assets. The pattern is now repeating, with a fidelity that borders on the supernatural. Those who choose to treat Burry's second disappearance as anything less than the clearest warning shot in modern market history are betting not against one eccentric investor, but against the entire recorded history of speculative excess. When the man who called the last great crash closes his fund a second time and positions nearly $1 billion to profit from the next one, the only rational response is to ask oneself, with complete sobriety, which side of that trade one truly wishes to occupy when reality finally, inevitably, reasserts itself with merciless force.